Nice to meet everyone. That's an extremely hard act to follow. Thank you so much. My name is Stuart Sutton. I'm co-founder and CEO of Current.
Hey, and I'm Trevor Marshall. I'm the co-founder and CTO of Current.
So it's nice to be here today. We're going to speak a little bit today about how to build a fintech unicorn company. We are based in the US of A, in New York. You may hear from my accent, I am English and also an import.
Yep, and I grew up in New York, but I don't have the charming UK accent that Stuart does.
There we go. So we'll make sure this works. I've got to point it at the right direction. No, it's not working.
Maybe we can get a manual next slide from up in the booth. Up, good, boom.
Oh, there we go. Thank you so much. So very high level, what is Current? So you know, we're a neobank, mobile-first bank, banking financial technology solution based in the US. And as you can see here, we have a bunch of products and things that are very well tailored towards the American market, but you may see some of the things that are applicable here in Abu Dhabi. So we've got a vision and mission statement. I think this is super important. When you're building a fintech company, and if you want to get to unicorn status, you need to know where you're driving over the next 3 to 5 years, but also over the next 10 to 20 years. That's where you get the mission and the vision statement from. And as you can see, our mission is to improve financial outcomes through inspirational and motivational products. That's important because that gives us a guiding light into where and how we build things and what we're doing over the next 3 and 5 years. And then the vision statement is to connect the world financially. I think that maybe explains where we want to go over the next 10 years and why we are also here in the region and specifically in Abu Dhabi to usher in a new future of wealth creation through a platform of open technologies. A real key there on open technologies. Okay, so that's our vision and mission statement. We've had a busy few years, like many people and many companies in the fintech space. We started Current in 2015. That's when we incorporated, which was before the term fintech was coined. It was coined in 2018. And as you can see here, we went from Series A to Series D over about 7 years, but very busy over the last 2 years, with Andreessen Horowitz leading the Series D and Tiger leading the Series C. So we have a good group of investors. We have a good board. We have Nigel Morris, co-founder of Capital One, on our board as well. And so you can see surrounding yourself with deep pockets of capital, people who know how to build not only finance, but also technology companies is really, really important if you want to be successful in this business. So the path so far, this is very specific to us. So, we'll have time for questions maybe at the end, 5 minutes or whatever, but like if you feel that you have a burning question, please shout over. But this is how we tackled the market. So what is the problem in America specifically? A majority of Americans earning something like $50,000 to $75,000 don't fit the business model of banking. Banking institutions accept deposits and then lend them out. It's a very old business model. I'm sure we're all very, very familiar with. Now, in America, there's a lot of people that live paycheck to paycheck, meaning the day they get paid is the day they need to spend all their money. And of course, that's not very useful for the majority of banks, because they can't lend that money out. And so their business model of lending doesn't apply to a very, very large and ever-growing demographic of America. And so there's a few other points to this. Not only is their business model wrong for the majority of Americans, they also have high operational costs. So they have branches, they have people in those branches. They also have legacy infrastructure and technology that costs a lot because they outsource all that. And so there is a technology solution here, there is a business model solution, and then there's a marketing and focusing part that can then unlock the productivity and the unit economics of this strategy. It's very specific to America, but I think it can be applied to many other countries. Okay, the opportunity. So going back into here, improving financial outcomes, you saw that in our mission statement. We think that's super important that if you're charging lots of fixed fees, overdraft fees, and all the rest of it, you're holding people down, right? And I get why banks do it, because they need to get an effective interest rate if they cannot lend to the majority of their customers. This is massive scale. We're talking tens of millions of people in America that need this kind of banking, tens of millions. A lot of people in cash and prepaid. A lot of people are misbanked, unbanked, and underbanked, right? And so it goes into the tens of millions of people. So there's an interesting TAM opportunity here. And it's unaddressed, right? So the majority of banks, they've been going for a long time. There's 10,000 banks and credit unions in America, and they don't want to change their business model. They've got other things to do, okay? So this is why banks when they look at companies like Current, don't feel that threatened because we're solving a problem for them. Okay? When it comes to like specifically who our users are, we go after younger demographic than the majority of our competitors, as well as the banks. 18 to 35 is our sweet spot, which unlocks interesting. Someone almost didn't break in time there.
Getting ready for Formula One.
Hopefully they're fine. Yeah, maybe racing for the Formula One. So the average age of our users, 18 to 35. If you look at some of our competitors, average age would be about 40 to 50. We specialize in this younger demographic. And there's a couple of reasons why. One is what it means to be a bank is unwritten for a younger demographic. You can actually talk to them in a different way. You can they don't actually know what a bank is for at this point, other than storing their money and taking it out. Right? So there's an opportunity to mold and craft a whole younger generation in what this is. And then two, defensible marketing and acquisition techniques. Market has changed. If any of you have kids, TikTok, Facebook, Instagram, YouTube, right? This does not work on anyone over 35. You already have bank accounts, but your kids or your kids' grandkids will look at these marketing channels, and they are underutilized for the vast majority of banks because they don't know how to use them. Okay, so this is the strategy of who we're going after. And then when you're looking at like where people are working, remember these people are working 18 to 35. It's the average person who's working in logistics, maybe in the military. We're looking at, in England it's working class, in America it's called blue collar. And so we're looking after ordinary, or trying to bank ordinary, everyday Americans that are not looked after or focused on by the banking industry, okay? Here's some of our product feature set. There is a massive list here. So we've split it into three categories: funding, management, and spending. I won't go after all of them. You can read here on the slide above. And we've starred some of the market-leading or industry-leading ones. And a lot of this product iteration and deployment is based on the fact that we have a back-end technology that is differentiated to not only our bank competitors, but fintech competitors as well, which we'll go into shortly. So as you can see here, philosophically, if you want to be a unicorn fintech, you need the chassis to be able to deploy products extremely quickly, because the barriers to entry on all these verticalizations are very, very small, right? Super easy to do this. And so engagement and re-engagement and retention are the main metrics that you need to do. You do that by deploying value into your main product. And that's why you'll see this chocked full of this. In another way, existing products, right? So we have storing balance, moving money, paying with card, earning rewards. This is a different way of segmenting and siloing them. Generating high yield and earning on assets. We have all these products, and they are live and working well for 4.2 million customers in America right now. We have actually now, I think, America has seen the deposit wars over the last 3 to 5 years with us and a few others trying to get those deposits in that are passed through spend through the interchange revenue model. And going forward over the next 5 years will be the lending and credit wars, where we'll all get our deposits or whatever we've got left and try and lend against them. And you'll start to see that innovation, building credit and offering credit over the next 3 to 5 years. That's where we're going next. Trevor, you can probably talk to some of this, but Trevor and I met in 2015. We both worked at Morgan Stanley, and we were talking about what the future of banking could be.
Yeah, we started with this idea that the way that money was working was fundamentally changing. And that was through a lot of the digitization that was happening, but it was also the early things that were happening in crypto. And so when we first started Current, we were looking at how do we be a part of that transition of the way that money works into the hands of everyday people. And so from the beginning, we took the philosophy of banks and the service providers for banks are not properly set up for this transition. What can we do to lay the groundwork to enable that transition and actually not only build that foundational piece, which is a lot of where I focus, which is on our core banking technology, but then also the delivery and distribution piece, which is how do we bring this and put it in front of millions of people. And so when you look at sort of the trajectory, it's been starting from this foundational layer of what does it mean to actually operate a core banking engine, and what are the key components needed for a consumer experience, and incrementally adding pieces of that engine to drive retention into the main interchange engine, which is our primary business model. And this is a little bit of our journey, but as you can see, we've actually been able to, because we control that core banking engine, accelerate product release and accelerate the offerings that we have, because it's now completely within our own control. So growing our team actually directly translates into deploying product. And for folks who have worked on growing teams before, it's oftentimes that the bigger you get, the slower you are. For us, we're able to release faster and release products that build upon what we had previously. And that's really one of the main edges that we have in this space.
Yeah, just to put that note there, you can see maybe very small text on this screen, but we're 200 employees in New York, right? That's a small division in any company. 200 employees. Overnight success, obviously 7 years. Overnight, that's what we get called all the time in America. Overnight success, because we're piercing the consciousness of the retail investor or maybe even the investor who's trying to get into a round. But 7 years to get to this point where we're deploying massive amounts of product and value that is really hard for anyone else to compete with. So this is the strategy that we have taken. Not everyone has taken this route. We've changed the game in many ways. So you've seen, one of our main value props early on was earned wage access. Now, we saw the network messages, meaning someone at Walmart or maybe in the military got paid, and a bank would wait for the settlement of that. Now, what happens is that we get the network message saying, hey, you should pay this person on Friday on a Wednesday, right? And so that means that we've got that money. We know that employer is good for it, right? But we'd have to wait 2 days for the funds to settle. So what we did as an innovation in, I think, 2017 time, was in using our balance sheet, just giving the money, saying, okay, we'll take employer risk. Walmart's probably good for it. The military is probably good for it. Social Security is probably good for it. We'll take that risk. And by the way, touch wood, we've been okay. There's been no credit events with any of these employers at this point. And so what this did was it gave people access to their money on a weekly basis, 2 out of 7 days early, right? That's extremely valuable. And in America, there's a penalty cascade, right? So they have their cell phone bill, they have their water and electric. And if they're missing, they're hitting around zero and they can't meet their obligations or something has happened, getting that money early without paying for it means that they can also pay off other things. So they're not getting penalty fees from all these other service providers. And so this has been the innovation that we have grown on. It changed the game because pretty much every other bank in America is now trying to copy it 5 years later. So Cap One also dropped all theirs. With a bunch of others. So that it's exciting for us to see.
Very proud of facilitating that change.
Right. And if you look at the unbanked numbers in America, they're down into the single-digit millions from 20 million when we started, 4.2 in current. So what's happening? What it takes to win in this space. I think we've kind of gone into it a little bit, but the first stage here is like, okay, as you can see, legacy institutions taking advantage of these things, and then second stage, we emerge, right? So this is what's been happening. Basically, incumbents being lazy, and we're seeing a wedge, a typical tech wedge to get in. Our differentiation, I think a lot of neobanks in our space have taken the opinion that if they build it and they attach a debit card to an existing financial product, that they will solve banking problems as well. This is not true. It's not going to work. And the main reason why is because you lack trust, potentially lack trust, and 2, you lack engagement. When you look at the engagement metrics of someone checking their bank account, their primacy, their prime bank account, it's something like 2 to 3 times a day. 2 to 3 times a day because they don't have other credit options. That engagement on a daily basis means that we can then cross-sell and use launch other products and services to attach to that primal engagement rate, right? So if you have a student lending product or you have a credit card, you're checking your bill once a month. If you have a student loan, you're probably checking it once a year. And so that engagement lack of engagement is a problem to cross-sell into other services. So this is why starting with banks or banking is a superior business model and strategy. And a lot of other neobanks have not done this.
I think one of the key points there is that oftentimes when you look at digital innovation across the financial services industry, it's about how do you sell a product that's existed for 20 years, but in a new way. So how do you build out new distribution channels? For us and the methodology that we've taken by building our own financial platform, we're able to actually build new products to deliver, not just focus on the distribution of an existing product. So tying a lot of things, if you've got at a bank a checking account, a savings account, an investment account, and credit account, how can you actually combine all of those into a single account and deliver different components of it, driving a single revenue engine?
On that note, Trevor and his team, CTO and engineers of Current, we've moved very quickly onto our own processing. So we've gone very deep and narrow in terms of technology, and we've just moved with a direct integration with Visa. Maybe you could go into that a little bit and how that's helped us.
Yeah, absolutely. So if you're not familiar with the interchange revenue model, merchants pay to accept card transactions globally. And that fee makes its way across their acquirer, acquiring processor, acquiring bank, network, issuing processor, issuing bank, and especially in the US where companies like us work with BIN sponsorship banks, there's not a lot of economics at the end if you build it sort of in the traditional go-to-market way. What we did is we decided to focus on the technology of that entire life cycle and take as many of the middlemen out so that we could build a compelling business model around processing. So these are not fees that we have to pass on to customers. We're able to benefit from their activity without having to monetize them directly. And then all we have to do as a product company is build tools that engage and lift the back end of the retention. So they're sticking with us for many years to keep them using the product. And so by being able to pull this directly with Visa, which we actually, not only did we launch on all new customers, we brought our entire 4.5-ish million customers over on a single day, which was a high stress day for us. We were able to bring them all under this new processing regime, and we've been able to pick up 30 to 40 points of gross margin on the interchange business its own.
Yeah, that's a good point. So what this is doing, right, it's really hard to do. It took us like 2 years of preparation and over 5 years of going into leading up to this point. But remember when I said legacy banks outsource their technology? This is what I meant by that. We're actually insourcing it. It means margin expansion. The second part means product innovation, which we'll get into in a sec. Yeah, okay, so you got a few slides here.
Yeah, when you think about what does it mean for us to have our own core, it comes down to 3 primary items. The first is the system of record. And that's really important because ultimately the way that our customers experience our product is a balance. That's our real product. Is if you've got $100, you open the app, that is our product. And the features of our product is how do you get to that balance? Well, you're getting a direct deposit from your employer. You're using your debit card. You're doing all sorts of financial activities that if you outsource the creation and the funds movements that are associated with those financial activities, you don't control your product. So that's actually the first place that we started. Then it comes down to how you tie those things together with account structures. And it's actually on the previous slide, you can see that the account structures gives us that flexibility of how you tie things together. So we actually, for many years, could work with multiple issuing banks on the same balance, which is unheard of and unprecedented when it comes down to deploying these types of products. And finally, tying it all together, you have your funds flows. And so what this gets us to is kind of what I was alluding to previously. You've got your 4 traditional buckets for retail banking at a bank. We can actually take those building blocks, put them together, and deliver that as a unified experience. And that's what we've been building for the last 7 years.
So finally, table stakes, third stage. You go into this credit building, lending, investing. Like Trevor said, we've built this. We've taken down all the verticalization. We've got the cost efficiencies, and then we're able to innovate on the products and then add more and more products as we go through. So, there we go. We got a little bit of a delay. So what's next for us? We're already a fintech company. We already hit over $2 billion in valuation by growing this existing business and adding to the products. Now, there is an interesting, I think, fork in the road for many fintechs going forward. It goes from, like I mentioned, depository to credit and credit building. So the next thing for us is focusing on the credit rails. As you can see from this slide, debit, when you look at card payments in general for America, you're looking at 31% going down, pretty much all down the affluency rankings, but you're missing out on 50%, right? So as you go into adjacent demographics, credit card use becomes more ubiquitous, right? So without us offering this, we're always going to be 50% of the addressable market. And so this is something that we are now focused on going forward. We've looked at and asked our existing demographic, our existing cohort and base, and also surveyed potential target markets. And pretty much everyone, the number one thing they want is credit building. Credit building is the number one thing. Now, no one wants credit building on its own. That's a useless tool. You just want credit, right? You just want the access to money. We're in a high inflation environment. It's pretty bad in most countries. It's fairly bad in America. And so a lot of people are solving this problem by credit. And so it has to be done safe and it has to be done well. And a large part of America, like I just mentioned, fall out of the business model of banking and also not the focus. The average FICO score for a bank in America in the top 10 bulge bracket of who they are extending credit to is 770. The average FICO score for us is below 600, right? So there's a large part of America that is feeling the squeeze and the pain, and we can get them there with a credit building product. So here's a few things of some of the value props that people who are only on debit rails are missing out on with the credit product. And so we want to be able to converge the benefits of credit without the risk of credit. That's really where we are going as a business. And so here you see some of the legacy institutions, like the incumbent banks, right? They're expensive, they're slow, and they're very verticalized in terms of credit building. The neobanks, they have a low attach rate because they don't have the back-end technology that we've developed. And then finally, credit building startups, again, it's their only business. It's very hard to scale that on its own. So if you're trying to build a fintech unicorn, you've got to understand where your competitors lie. You've got to understand what your edge is. And then you've got to see where your risk reward is going forward and being able to acquire or distribute to the right people, right? And you're doing this constantly, every year, every 3 years, reassessing where you position yourself. And so we're launching Current X in the end of Q1 next year. This is exciting for us. This again, conforms, it looks like a checking account, current account in America, in the UK, sorry, with all the functionality and value of a credit product. You're going to see a lot more from Current on this, but you also see the market move towards this direction, in our view. And so this gives you a few ideas about what it does. It gives you credit benefits in terms of building your credit score, getting exceptional value in terms of points and rewards. Obviously, America being very specific in consumerism and the direction of like pushing people, like asking people to spend as much as they can, and then obviously getting the fraud protection that you normally get from a credit product. And then finally, frictionless. It's really hard, like we already said, to do this via banks, and neobanks have a weird attach rate. And then finally, holistic banking. We're tying in all the things that we've got. Remember this, you can't win, you can't be a fintech unicorn without all those products. High yield, checking accounts, insights, budgeting, points and rewards. And that's it. Finally, I would say this, product's really, really important, but the technology side is how you get there. You can't build product by just going for third parties. Your unit economics won't work. You'll give out all your economics to someone else. And so you need to build with a strategic, long-term mindset. You need to be a missionary, not a mercenary. If you're looking for short-term gain, just trying to make a quick buck, like going into credit or going into one of these small verticals, I don't think you're going to win. You're not going to be a fintech unicorn. But if you start slow, get rich slow, right? Align yourself with the customers and their problems, and be customer-centric. Align the technology so that it makes sense for the products that you're going to deploy as quickly as possible. And that product velocity is what will keep you as number one. That's how you build a fintech unicorn. Thank you.